makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London with the conversations that matter. Here's what's coming up on today's programme. Stocks struggle to maintain momentum after another record-breaking session on Wall Street as investors shrugged off hotter than expected US inflation. The world's largest car maker, Toyota, agrees to wage hike demands from unions, adding to the case for a BOJ policy shift next week. Plus, the UK economy rebounds in January with modest growth after slipping into recession in the second half of last year. Let's check in on these markets then. As we said in the headlines, records again coming through for the US yesterday and European stocks. A bit of a different picture so far in the session, a bit of a breather, maybe a bit of profit taking as we wait for the next catalyst. And yes, equity markets in the US were able to charge through and look past that stickier inflation print that came through in terms of the CPI. Currently on the UK, the FTSE 100 is flat. Yes, we are back in growth territory. It seems modest growth, 0.2% for the month of January. But of course, a change of direction given the contraction we saw in December, 0.1%. We are setting ourselves up for a first quarter of growth here in the UK, it seems. Over in France, the CAC 40 is up 0.2%. The Spanish IBEX performing relatively well, up 1% as things stand. The FTSE MIB over in Italy, of course, up 0.2%. In terms of the sector-by-sector breakdown, it's retailers and utilities coming in through with some of the strength as healthcare disappoints. Let's flip the board and have a look then at US futures before we go cross-asset and dive through some of the currencies and fixed income. Then S&P futures currently flat again after the fresh records that were broken yesterday. NASDAQ futures 18,455, pointing lower by 21 points. Again, it was Oracle and Nvidia that led the charge yesterday. Nvidia notching up another 7% gain in the pricing yesterday. The European futures, or at least the European session so far, as I said, flat at 5.06, again, after the records that were broken yesterday across European stocks. Let's go cross-asset then, have a little look again at what's happening with some of the currencies. The pound, of course, in focus for us today on the back of that data, but also the Japanese yen. Given that we did have this wage agreement coming through from Toyota, again, the biggest car maker, of course, globally, and they have agreed to the demands from one of the key unions around wages and around bonuses. So that is leading to expectations continuing to fuel the view from some, at least, that the BOJ does have now space to raise interest rates next week for the first time since 2007. They're still waiting on that full picture that should come through on Friday from one of the main unions in terms of those wage negotiations before they make a clear call. That is the Bloomberg reporting. The pound, currently you're looking at a little bit of movement when it comes to the pound. We're weighing up, of course, the wage data that came out yesterday, 127 on the pound versus the US dollar, and not a huge amount of movement in gilts. Yields up just 1 basis point currently on the UK 10-year. The Japanese yen currently at 147, just down 0.1%. Bitcoin continues to be in focus for us today at 73,455, breaking through that 73,000 level. Of course, the inflows into the ETFs and then expectations around a potential halving in April, capping the number of Bitcoins in supply. So we'll keep across that story for you as well. But let's get back to the inflation prints out of the US and what it tells us about thinking from the Federal Reserve. Underlying US inflation then topping forecasts, as I mentioned, of course, for a second month in February. The advance likely to reinforce the Fed's cautious approach to cutting rates. Very pleased to say joining me now is Randy Kroszner, former Fed governor and professor of economics at University of Chicago's Booth School of Business. Randy, great to have you in the studio to digest this number.
Sure.
What stood out to you? Is this a sticky inflation print that we're seeing in the US, or is it a more entrenched inflationary picture that causes potentially a challenge for this Federal Reserve?
And that's exactly what the Fed is trying to pull apart, and that's why Jay Powell said he wanted to see a little bit more data before coming to a definitive conclusion of when they can move. Now, they usually focus on the so-called personal consumption expenditure index, not the CPI. The PCE is a little bit better balanced in terms of the role of mortgages, or I should say the role of different parts of the consumer basket, and so they prefer that one. But this still is suggestive, and I think will give people pause. Certainly, no one's, I think, going to be moving in the next week, but they may leave the foundation for a move in June.
OK, before we get on to your views on where they land and the sequencing, you say it's possibly June. In terms of unpacking the basket of inflation that we got through yesterday, with all the context, as you say, that the focus is really going to be on PCE for the Fed, we did see goods inflation ticking up a little bit. That seemed to be something of a surprise. Do you expect that to be short-lived, or is that indicative of a more concerning trend?
So I think the goods are going to be more volatile because that's going to be more energy and commodity prices that sort of move up more up and down. And so that's why they tend to look at core that strips that out. But we're still seeing fairly strong growth in services. And in particular, it's still strong wage growth. Now, that's great for workers, but more of a challenge for the Fed.
And you mentioned Jay Powell, and he said, of course, in testimony last week that we are getting closer. He wants more confidence. Him and the FOMC, they want more confidence in terms of the data that they're seeing before they act, before they cut rates. But he says we are getting close. I just wonder if there's a concern that he may have to walk that back. It seemed to be relatively dovish from Jay Powell. Are you concerned that he may have to walk that back, given what we're seeing on the data front?
Well, so far, I don't think there's enough data there to say that he's going to have to walk that back. But he's made it very clear he needs to see more data before moving. And so if the data don't move in his direction, I think he doesn't have to walk anything back. He can just say, we haven't seen the data yet to be able to make that move. OK. We're
looking, of course, for the forecast, the updated forecast from the Federal Reserve, or the dot plots and the potential revisions there. The markets, of course, have gone from the start of this year pricing at about 7 cuts to a little over 3 right now. How do you expect the revisions to the dot plots to evolve? What are you expecting to see from that?
So I don't think we're going to see dramatic revision to the dot plots. I think the markets have finally gotten it. I thought it was just sort of crazy that they were thinking that there are going to be so many cuts at the beginning of the year. And I think the Fed has been fairly consistent in their message. And finally, the markets are starting to move to be roughly where they are. I don't see that the data has changed so much that would dramatically change the dot plots. I think 3 seems to be roughly right. The question is, will they start in June or maybe start a little bit later?
OK, so 3 seems relatively reasonable. Where are you in terms of your views on the US economy? Jamie Dimon, a big line crossing this week when he said, look, we shouldn't write off the risks of a recession. It is still potentially in the cards for the US. After almost kind of consensus view amongst the guests we speak to, that soft landing is there now for the US. Where do you land on this debate?
Where do I land? So, there's soft landing, hard landing, softish landing. I'm kind of hardish landing. Okay. That is that I do think that there'll be a substantial slowdown in the second half of the year. Now, why is that? Because real interest rates have finally gotten positive for the first time in 20 years. They've only been positive for about 6 months. That is, the interest rate, the 5% or so interest rate, has been above the inflation rate only for about 6 months. Real wages are finally starting to grow in a positive way. Now, remember, when prices were going up at like 8%, you could sell stuff at 8%. Your main input cost was going up at 3 or 4%. That's a great trade. You're going to buy a lot of that input. When real wages start to grow up a little bit more, and you're not being able to sell at quite the same pace or same pace of price increases, you may start to see a little bit of weakness in the labor market. I'm not calling for recession, but I think a slowdown from where we are. We've been just having screaming growth in the U.S. I don't see how that's going to quite keep in the second half of the year.
That pricing power then ties into the story around equities and around what we're seeing in terms of stocks. Does that suggest that stocks are getting a bit ahead of themselves then? If you see a more challenging picture in the second half, does this rally in U.S. stocks look a little unsustainable to you?
Well, I'm usually not in the business of predicting the exact level of the stock market, but I do think that markets seem to be kind of priced to perfection. They seem to be thinking that, soft landing or no landing at all, we're going to continue to have really strong earnings growth. I'm a little bit more concerned that there could be some challenges to that.
You've been also thinking, I know, in great detail about the proposals around additional capital reserves for the US banking system. And this also caused some surprise and certainly generated headlines when Jay Powell suggested that the proposals would be either radically revised, rewritten, or potentially scrapped altogether. You've been thinking about the potential risks of this proposal. Give us the detail on why you think actually the proposals, if they were to come into force, they could actually cause more risk for this financial system versus reducing the risk.
Because I don't think there's been a really careful cost-benefit analysis that's done. Certainly you want to make the banking system safe, but you also want to make the entire financial system safe. So if you keep raising capital requirements, what happens? More and more activity goes outside of the banking system. And we've been seeing that, whether it's private equity coming in and doing private debt, so many other areas that you're seeing a lot of stuff going off into the so-called shadows. There's potentially more risk there because the regulators as well as market participants don't have as much line of sight. And that's where you could potentially get these unintended consequences of, sure, you're trying to make the bank safer, but you could maybe make the entire system a little bit more risky.
Is that where the regulatory lens needs to be then? On the off-balance sheet banking sector, the shadow banking? And how concerned are you that potentially there's a black swan event there?
So I think that's where we really need to have a stronger line of sight. We need to do more data gathering there. We need to have better understanding of the risks of interlinkages amongst those non-banks as well as between the non-bank sector and the banking sector. I think that's really where we need to have a lot more focus. OK,
Randy Kroszner, we're going to get your views on the Bank of Japan as well, the ECB as well, in more detail just in the next couple of minutes. Very pleased to say Randy Kroszner, the former Fed governor and professor, of course, of economics at the University of Chicago, will give his analysis and his views on some of the other central banks making waves, of course, today and throughout this week. That is in the next couple of minutes. Let's take a look now at some of the other top stories on the terminal right now. And the election rematch is on. Not a big surprise. We knew this was coming. Donald Trump and Joe Biden securing enough delegates to win their party's nominations, setting up then a rerun of the 2020 US presidential election. It comes after both passed the delegate thresholds to clinch their party's nominations for the election in November. The nominations will be made official at party conventions this summer. Now, the first ship carrying aid to Gaza from Cyprus has set sail. It is the first shipment as part of a new marine corridor announced last week. Under the plan, ships will carry food and medical supplies from the Cypriot town of Larnaca across the Mediterranean Sea to Gaza, where the US plans to set up a temporary port to receive shipments. It comes as Israel plans an assault on Rafah, the last major city in the enclave where residents are sheltering. The European Union is on the verge of enacting comprehensive guardrails on the fast-developing world of artificial intelligence. The bloc's parliament will vote today on the AI Act, a landmark set of rules that could set the tone for how AI is governed in the West. But the legislation's likely passage comes as companies worry the law goes too far, while digital watchdogs say it doesn't go far enough. Coming up, the yen strengthens as the world's largest car maker, Toyota, agrees to wage hike demands from unions, adding to the case for a BOJ policy shift next week. We'll get Randy Kroszner's views on whether or not the markets, global markets, face risks from this potential shift in the BOJ. That is next. This is Bloomberg. Welcome back. Now, expectations are rising for the BOJ to move on rates after Toyota confirmed it will meet its labour union's demands for wage hikes in full. Toyota, of course, the world's biggest car maker, a major employer in Japan. So that's consequential. Let's bring back in Randy Kroszner, then former Fed governor, of course, and professor of economics at the University of Chicago's Booth School of Business, and obviously a fantastic person to have on to talk all things Fed, BOJ and ECB. Randy, I was speaking to a former BOJ official yesterday, and he said the likelihood for him of the BOJ going next week with a rate hike, the first one since 2007, he put that at 70%, and he also suggested they could also drop yield curve control. Where do you think the BOJ goes next week? Do you think they've seen enough to give them the confidence to make this move?
So I think Ueda-san wants to go very, very gradually, and I think that's the kind of mantra that he's had so far. They're facing a lot of challenges because, obviously, as you said, there's very strong wage growth, not only at Toyota, but a number of the other wage settlements have been very, very strong. But they're also in a period of very low GDP growth, and also inflation expectations haven't quite moved up to the 2% area where they want them to be. So I think they'll move cautiously. There may be some slight moves in the direction of move up next week, but I think it's more that they're going to provide the foundation for moving down the line. But I think they need to see a little bit more to make sure that consumption is still going to be strong and that inflation expectations move up.
And when you say down the line, you think April, or do you think they could even push it further back?
I think it'll depend. I mean, if we're seeing some weak economic numbers overall. If those turn around, then I think they'll move more rapidly. If those are still quite weak and we still don't see inflation expectations moving up, it could be a little bit later. But I think there'll be gradual moves in each of these steps in that direction.
Okay, cautious, gradual, the timing still TBD. Are global markets ready for this shift from the Bank of Japan? What do you expect to see in terms of the global market ramifications of this move?
Now, this is something that's very important. Japan is a very big place, and Japan has a lot of debt outstanding. And so obviously as interest rates go up there's going to be more flow back to Japan. Most major countries of the world are issuing a lot of debt, and so there's going to be a lot of competition for who's going to buy which debt. So far, the bond vigilantes haven't come back out. They seem to be happy to say, oh, lots of debt, no problem. At some point, they will rise up. I hope it doesn't come too suddenly, but at some point they'll come back, and that's going to be a problem.
Has that surprised you, that the bond vigilantes have so far stood on the sidelines? And what do you think would be the trigger then for that intervention?
That's always the key. We never know exactly what triggers it. Something changes people's confidence. And look at countries like Argentina. They kind of go along very well for a while, and then boom, suddenly something happens and people get very worried. Is the rest of the world like Argentina? No, but you worry that there could be some sort of triggering event that make people say, gosh, I'm not so sure they're going to be repaying, or I'm not so sure they're going to have the economic growth to be able to make those payments.
On the ECB, a couple of dovish comments today suggesting maybe from the Bank of Governor over in France and another central bank governor who sits, of course, on the ECB Governing Council, suggesting that possibly April, possibly June. There's a debate as to whether ECB has to wait for the Fed to go first. Is the ECB, though, given the dynamics in terms of softer inflation versus the US and a much weaker economy than the US, is the ECB at risk of a policy mistake?
So I think they have much more pressure to move more rapidly because, exactly as you said, much weaker economy. And the U.S. economy is still quite strong. And so I think they're going to get pressure to move more rapidly. But I think they are looking very much at what the Fed is going to do. And so I think how the Fed characterizes what their next move is going to be, because my guess is the Fed's statement next week, they're not going to say they're going to move, but they're probably going to say they'll move soon, leaving the foundation for moving in June or next move in the summertime.
OK, the gravitational pull of the Fed, always.
Yes,
Randy Kroszner,
right.
Randy Kroszner, thank you very much indeed for the analysis of coming on, of course, into the studio to walk through that CPI print, the implications for the Fed, and, of course, where the BOJ and the ECB could go as well as they weigh up their own challenges. Randy Kroszner, former Fed governor, of course, and professor of economics at the University of Chicago. Coming up, Volkswagen has said it expects its slew of new models to drive sales in Europe, but how will the German car maker reinvigorate EV demand? And which of those factors are in VW's control to change? We discuss that next. This is Bloomberg. Now, Volkswagen expects orders in Western Europe to pick up in the coming months as updates to popular models are rolled out. The German car maker has a pipeline of more than 30 new products this year and is looking to boost momentum into the shift to EVs. Here's what CFO Arno Antlitz said on VW's outlook.
2024 will be a challenging year. We have macroeconomic environment is uncertain. We have interest rates still high. On inflation on the cost side, and there's a lot of competition in the BEV markets. But there are also positives. The market will grow slightly, and we bring some great new models specific.
OK, let's cross over to the man who actually spoke to Arno Antlitz earlier, himself, Bloomberg's Oliver Crook, of course. Ollie, what else did the CFO have to say about the outlook?
Yeah, it's really interesting to look at where Volkswagen is in its sort of trajectory now, because you remember this event 1 year ago is where they announced that behemoth of a spending plan, 180 billion euros that they were going to put in to really catch up on the battery electric vehicle transition, dealing with all the software. And that was, again, a year ago. And today, it's all about execution. That was a reorganizational year. This is the year of execution. As you heard from Arno Antlitz, this is going to be a tough year. And they're not shy about saying that to investors right now. This is also going to be the year where they peak in terms of cash burning. And as you say, they've put out 30 new models that are going to hit the streets this year. And what's interesting is that 30 models across combustion engines, hybrids, and battery electric vehicles. So they're at a moment now where they have a three-pronged approach, which is going to cost a lot of money, and they're hoping for that to kind of like focus a little bit further into the future. Next year, they're going to start that ramp up, and then 2026 is really when they hope that will deliver by. The question is for investors, is that timeline good enough? We heard similar things from Porsche yesterday. Investors were clearly convinced there because it had its best day on record, up 11%. But the question for Volkswagen is not Porsche.
Yeah, well, indeed. What do they have to say about the crucial market in China then, Ollie?
What I found very interesting in the numbers that we had here is there was actually very little about China, which, as you know, Tom, is sort of conspicuous given that it is the biggest market that you have for Volkswagen in all of their portfolio. And last year, sales in China rose only 2%, and that's versus 20% for Europe and North America. So I asked Arno Antlitz what their strategy is there and what does it look like going forward.
We are deliberately prepared to give up market share in the next, I would say, 1 to 2 years, 2024, 2025, in order to find a sound compromise between margins and volume. But from 2026 onwards, we want to regain share also in the BEV segment.
So it's interesting, the CFO there saying basically they're willing to give up market share for a couple of years, which is kind of a risky strategy. They may not have much of a choice because it's much harder to gain back market share than to defend it. In terms of the bright spot, where is the growth going to come from if not China? They said the United States.
Really interesting line there from the CFO. Oliver Crook, of course, in the ground in Berlin. Thank you. Coming up, we're going to be speaking to Gershon Distenfeld, Director of Income Strategies at AllianceBernstein. That is next. How to position in these fixed income markets. This is Bloomberg. Stocks struggled to maintain momentum after another record-breaking session on Wall Street as investors shrugged off hotter than expected US inflation. The world's largest car maker, Toyota, agrees to wage hike demands from unions, adding to the case for a BOJ policy shift next week. Plus, the UK economy rebounds in January with modest growth after slipping into recession in the second half of last year. Good morning and welcome to the Pulse. I'm Tom McKenzie in London. Let's check in on these markets then. Yes, fresh records across Wall Street yesterday, driven by the likes of Oracle and Nvidia. Also, the highs coming through for European stocks, fresh records there as well. Different picture today, a bit of a breather coming through. US futures then, S&P futures flat currently, still above that 5,200 level. NASDAQ futures pointing lower by just 0.1%. And here in Europe, you're seeing very modest gains of about 0.2%. Retail as a sector is leading the gains, up 2.6%. On the downside, autos off by 0.4%. Now, bond prices slumped yesterday after the US Treasury's monthly 10-year note auction drew weak demand. This is despite the fact that yields rising into the bidding deadline off the back of inflation data that exceeded expectations. For more on this, I'm joined by Gershon Distenfeld, the Director of Income Strategies at AllianceBernstein. Gershon, great to have you in the studio. You're not too concerned. Medium term, you think the inflation story holds up in the US. The downside keeps coming.
Yeah, so, we're back to the kind of bad news is good news as we saw the equity markets rally on what was a higher than expected print. I would note, I'm usually not a big fan of going into the hundredths or thousandths of decimal place, but the print was 0.358, which rounds to 0.4. So interestingly, had it been 100% lower, it would have been 0.3 and people wouldn't have been as concerned. But look, inflation is still too high as far as the Fed's concerned. And there's going to be no sense of urgency now to cut rates. I think, March has been off the table for a while. Probably May's even off the table. We're still expecting the first cut around June. But what's most important is actually not when the Fed starts cutting. It's how much, how deep, how fast, why they're cutting. Those are things we have to look for in the coming weeks.
Talk to us about that. If they're in no rush to move, given the relative stickiness of this data, how does that inform the dot plot and the forecast that we expect to get?
Well, the dot plot's going to continuously change. The market was pricing in 6 cuts as recently as a month ago, and now is pricing in about 3. Now, of course, that doesn't mean the market's predicting 3 at this point. That's an average of everything that could happen. In fact, I think it's more binary. If inflation is sticky, the Fed might not cut at all this year. I know that's crazy, and I think the markets would not be thrilled about that. But
that's not your base case.
That's not our base case. Our base case is they're going to start to cut. But, they might cut much harder than you think. This has been almost, it's an overused phrase, a Goldilocks scenario. You've actually had the soft landing. We studied, the news media used the word soft landing very often before every single recession in the past 30 or 40 years. This time it actually may be happening. Now, we don't know, right? It's not just the level of rates, it's the time, right? And rates have been elevated for quite some time at these levels. So the longer that goes on, the more the chance that something breaks and that, of course, growth slows.
Randy Kroszner telling us just in the last 15 minutes or so, he thinks there's going to be a harder landing in the second half. He's concerned about what's happening in terms of wages and the squeeze potentially on corporate profits. You seem to be pushing back on the Goldilocks scenario, the soft landing scenario. Is a recession part of the forecast for you? Do you at least have to calculate around that risk?
I think you have to put some percent on it. You know, maybe for us it's 10 or 20% on a hard landing. We're going to have to see. You know, it's been, like I said, it's been very, very, it's been very easy so far. But economic weakness can come in very, very fast. And look, the Fed is, what they're really mindful of, they haven't talked about it recently, but a year ago what Chair Powell was talking about was, you didn't want to make the mistake of the 1970s, right? The 1970s, they declared the war on inflation over, they started to cut rates, and then inflation spiked, and they had to raise rates to close to 20%. Now, I don't think that's in the cards right now, something like that, but they're trying to balance that. And so far, I think you have to give them, you can't give them anything but an A+ in how they've done so far.
What is the market vulnerability then? They get an A+ from you, the Federal Reserve. What is the market vulnerability if they cut later than June then? How vulnerable is this market to that cut being pushed back?
Well, I think you're going to see a lot of volatility because of it. Again, as I said,
at the front end,
you're going to see a lot of volatility at the front end and at the long end also. Look, I look at the long end and I see, like, if the Fed says they're going to try and get to 2% inflation, they're admitting probably 2% long term is going to be hard. There's some secular pressures, deglobalization, rise of populism being a couple. That's going to probably, in our view, going to mean that inflation is going to be closer to 2.5% long term. But, you know, real rates have averaged 175, 200 basis points over the past 100 years. So I look at, you know, a 10-year, a 30-year in kind of the low fours, and I don't see that as mispriced in either direction.
Talking about credit spreads, they're tight. Does that worry you? Does that close off the opportunities? Does that tightness continue in this environment?
Well, you know, the tight spreads are the norm. You know, medians are quite a bit lower than averages. When they blow out, they tend to skew the averages. So spreads can stay tight for a very long time. Like a year ago, I was sitting here and pounding the table, credit is cheap. I don't think that's the case anymore. I also don't think it's going to be a disaster by any means. You know, absolute yields are still high. You know, defaults are going to go up, but that's really priced into the market already. You know, there are a lot of, especially the lower quality bonds in the U.S. are priced at 50, 60, 70 cents on the dollar. When those default, doesn't necessarily impact the market. I remind people, you know, everyone thinks that 2008 was such a big default year. 2008 had less than 2% defaults. We know high yield was down 30%. It was 2009 where all the defaults came, yet you had 60% returns. So there's a huge lag effect, and we do expect defaults to go up, but that doesn't mean returns are going to suffer all that much, if at all.
So where along the risk spectrum in credit do you want to be sitting right now?
We want to be in the higher quality part of high yield. If you look at the sweet spot of credit in general, tends to be triple Bs and double Bs, so the lowest part of investment grade, the highest part of high yield. And that's because the market's very segmented. You know, that line between high yield and investment grade is actually artificial. It was created by rating agencies and insurance companies, you know, many decades ago. But the mentality of those investors are very different. In investment grade, you know, people feel like no one's going to fire me if I buy the debt of Walmart in my portfolio. But if I buy some cuspy triple B energy company and it gets downgraded, I have to sell it at a depressed price, right? That's going to get me in trouble. High yield is exactly the opposite. People are what I call yield hogs. They want to get as much yield in the portfolio as possible. So that actually means you look at, by far, and it's pretty consistent over the 40-plus years we have of data, triple Bs and double Bs have by far the best Sharpe ratios out there. In fact, you know, triple Cs, for example, they don't return any more than double Bs over time with twice the volatility. We have a name for them. You're familiar with the term fallen angels, as we all are. Investment grade companies that used to be, investment grade companies that got downgraded to high yield. We call original issue triple Cs born devils. You only want to buy those when they've gotten beaten up and their prices are depressed.
Okay, so you're steering clear of the triple Cs for now.
We're very, very, very cautious.
Are you getting the yields you want to get in Europe?
Yeah, you know, it's interesting. As a U.S. investor, when you hedge back to dollars, you're picking up a couple hundred basis points. So the hedge yields are actually higher. And, you know, even though we do expect probably weaker growth or more slowing growth in Europe than in the U.S., credit quality tends to be better like for like. All else being equal, if you buy a bond at the same level in U.S. and Europe, almost certainly the European bond has a lower credit risk, lower default risk over time.
What are your favorite sectors within credit right now?
I don't think there's anything that we love particularly in credit. Like you said, spreads are tight. There's nothing that stands out as a big anomaly to us. I think the key right now is just to be very diversified and probably stay away from some of the problem credits. It's a credit by credit kind of decision. Nothing really stands out as overly cheap or overly expensive.
You have a view, and you see value in high yield versus in high yield versus equities. And you look at the S&P over the last 12 months, up 30%. How do you make that case that you want to get exposure to high yield versus equities, and what kind of portfolio shift would that look like for you? Yeah,
people don't like to make that comparison. They view an investment in high yield as taking up the risk in your bond portfolio. If you look at it more holistically, there's I think a more clever way to look at it, which is you can take some risk out of the equity side, and particularly after equities have rallied so much. One of my pet peeves, people talk about equities don't have duration. I think that's ridiculous. They're the longest duration asset class out there. They're perpetual, right? In theory, they should, an equity price should be the present value of all future cash flows. So we've actually we talk about the Fed a lot, short-term rates. Let's talk about long-term rates, right? Which is the best proxy we have for the long-term risk-free rate, let's say the 30-year Treasury. We've gone from sub 2% a couple of years ago to over 4%. Yet, any other asset class with duration, quote-unquote, would have sold off, and equities have rallied. So I'm not predicting you're going to have a disaster in equities. I don't know. But I do know that a 20 times multiple when you have a 4 and change percent long-term risk-free rate is very different than a 2%. And I think high yield can compete. Most equity strategists are telling you don't expect the 10 to 12% returns going forward. Expect more 6 to 8. High yield is going to be competitive with that. What is consistent, though, is high yield has about 60% of the volatility of equities and much lower drawdowns. All
right, making the case then for high yield credit versus equities in this environment. Gershon Distenfeld, thank you very much indeed. Director, of course, of Income Strategies at AllianceBernstein. Now, let's briefly check in on the markets for you right now. The European Stocks 50 hitting 5,000 points, currently up 0.4% so far in the session. We have had a few dovish comments from a couple of the ECB central bank officials suggesting that maybe the first cut could come potentially as soon as April, more likely in June. That from the central bank governor, of course, of France. But you're seeing the Euro Stocks 50 currently up 0.4%. Breaking through 5,000. Across your sectors, retail, the strongest gainer across your sectors, up 2.5%. On the downside, autos down 0.5%. Coming up, can a return to vintage Adidas styles or Adidas styles help the brand reset? We're going to take a close look at those results. That is next. Nice pictures, guys. This is Bloomberg. Welcome back. Now, European retailers have delivered, well, a mixed set of earnings this morning. Adidas reported a higher full-year operating loss of €377 million. Meanwhile, Zara owner Inditex boosted dividends by 28%. After a record year, of course, for the owner of Zara. Let's get more then from Andrea Felsted from Bloomberg Opinion. Andrea, let's start with Adidas and the earnings that came through. It's been a struggle, obviously, for this company. A lot of legacy issues to work through. Of course, their exposure to the US rapper Ye and all that stuff, the inventory drawdown they need to work through, FX. What stood out to you from these earnings?
I actually thought the numbers were pretty good, actually. When you think a year ago, they were forecasting an up to 700 million loss for last year, and they've actually made almost 300 million in operating profit. So that's a big swing. I thought Inditex was pretty good. Zara still on a tear. Massimo Dutti, the quiet luxury favourite, also doing quite well. So not a bad morning.
Quiet luxury favourite, Massimo Dutti.
Yeah, very quiet
favourite.
luxury.
OK, yeah. Interesting. And the dividend. Talk to us about the dividend raise then, because that seems to stand out. The markets expected about half a euro. They got about €1.5 from Inditex. What is the outlook for this business?
Pretty good. I mean, they announced a big investment this morning, or 1.8 billion euros this year, regular capital expenditure, about the same amount over the next couple of years in logistics. Some of the initial reaction wasn't very favourable, but, they've got a lot of cash, and it's good to see them investing. They forecast further growth, so they're investing behind that growth.
And Zalando is the best performing stock across the European benchmark right now, up close to 13%. How have they... the investor reaction, clearly, a lot of enthusiasm. What are they doing right at Zalando?
They're trying to be a provider of web services for other brands, e-com for other brands, which has had a bit of a mixed, record across the industry. But, Next also has got this very successful platform business, is where it sells and provides services for other brands. M&S also selling other brands on its website. So it's trying to emulate that, and it seems to be a good reaction to it.
Yeah, investors certainly rewarding that stock right now. That company, the stock up 12.8% or thereabouts on Zalando. Andrew Felst, thank you very much indeed, of course, from Bloomberg Opinion on the retail space and the earnings that have crossed through. Now to a very, very important story that's been reported out by the team here at Bloomberg. The UK's medicines regulator has seized nearly 900 fake Ozempic pens so far. That's as unscrupulous individuals try to capitalise on the weight loss frenzy with counterfeits that range from useless to actually potentially deadly. Let's take a closer look at what's been discovered then. The top pen in this image is the real Ozempic pen. The bottom one, an example of a fake product seized on a raid in the UK. Ashley Furlong has been writing about this story for Bloomberg. The investigation actually seen some of these fake Ozempic products. What do we know about what's been going on?
What we're seeing is quite significant numbers of pens being seized in the UK. They're coming from abroad. But I think if you look at it in the bigger scale of counterfeit medicines globally, obviously this is still, just a drop in the ocean. But very concerning, as if any of those pens potentially got to patients, it could be potentially deadly as they contain insulin, many of them.
So how big a problem is this, and how is the UK's approach to tackling it different from, for example, their counterparts in Europe?
I think it was a significant problem, and the UK came down very quickly and very strongly on this. The UK Medicines Agency has a team within it that does criminal enforcement, and that team actually has been leading on this, on tracking down these fake Ozempic pens, and they believe that they've got over the worst of it. Obviously, globally, we still have to see more products are coming to market. Everyone wants to get into the weight loss game, and criminals are watching closely.
Who's making them? Where are they coming from? Where are they being sold? And is the UK finally on top of it, as you say?
So they're coming from abroad, and they're being stopped at the border. Obviously, we don't have the specific details of the criminal investigations. They can't really give us all those details. But they're not being produced necessarily in the UK, and it looks like most of them are being stopped. And there have been a few hospitalizations, I think, in the UK, but it seems like the regulator is being able to clamp down on it.
Is there a response? What are you hearing from Novo Nordisk, the maker, of course, of Ozempic, Wegovy? To what extent is there an obligation on them to take steps to combat this kind of issue?
They're taking this very seriously. Obviously, it's potentially very bad for their brand, and also they don't want patients to be harmed. So they are actually on the ground. They have private investigators actually searching for these pens as well, and then actually reporting it to authorities.
OK, so they actually have private investigators doing some of the work as well. How big a problem, if we take a step back in terms of fake medicines, fake drugs globally, how big of an issue is this?
So this is pretty small in the big picture, but I think what it highlights is that this is, a growing issue of counterfeit and illegal medicines, coming through supply chains. And we've seen this increase over the past couple of years. So it's something that criminals are definitely catching on to.
OK, Bloomberg's Ashley Furlong, thank you very much with that investigation into the fakes around Wegovy and Ozempic and what's being done to try and tackle it. Coming up, Boeing's crisis is spreading to top US airlines as delays in aircraft deliveries slows output. We look at how aviation is coping under not so friendly skies. That plus your other key corporate stories next. This is Bloomberg. Welcome back to some of the key corporate stories from across the Atlantic now, starting with Boeing, whose slowing output is said to be derailing the growth plans of the carriers that rely on its jets. Let's bring in Bloomberg's Charlie Wells for the detail. Charlie, can you map out then how the fallout from Boeing's January 737 MAX incident is spilling into the broader industry? It's not simple as Airbus filling the gap, is it?
Yeah, I mean, the planes are literally delayed, Tom.
Yeah.
And that is a problem for these airlines, which, kind of post-COVID, they'd really been hoping for that bounce. And this is really kind of throwing a spanner, as you guys say in this country, into the works there. And I mean, look, there was an industry conference put on by JP Morgan, and a lot of these CEOs of these airlines have had some pretty harsh words for Boeing. So Scott Kirby, CEO of United, said that, they've literally had to tell Boeing to stop making the 737 MAX 10s for them that they'd ordered. The CEO, Bob Jordan of Southwest, said that we all need Boeing to be better. And actually, Southwest isn't expecting to get any of those 737 MAX 7s that they ordered. And that's cutting into the airline's capacity. That means they've also had to slow hiring. So 50% fewer pilots, 60% fewer flight attendants. Wow. And so, yes, when you have that choice between two companies, when one goes down, it's really difficult.
Huge ramifications, indeed, that we're seeing ripple across the airline industry then, as how they adjust to this shortage of planes. Switching focus to the semiconductor space, and one notable standout from the session yesterday on Wall Street was Nvidia. Shares up, close to 7%. After at least two sessions of downside, right, for the AI chip maker. What is going on with Nvidia? Was this a buy the dip trade, or is there something more fundamental at play?
Good question. I mean, there had been that concern about the rout. I mean, $172 billion knocked off your market capitalization is going to leave, people a little bit nervous. And I think there was that concern that, Nvidia had gotten into overbought territory. I mean, compared to a year ago, that stock is up 300%. I mean, those are some really big numbers. And look, they were lifted, it seemed like, by tech. There was positive sentiment on tech yesterday. Oracle, as we talked about, had better than expected earnings. And interestingly, Wedbush analysts pointed out that Meta put out this blog post that said they were going to use thousands of NVIDIA chips in their generative AI infrastructure. That could have been a boost, but let's watch to see if this has momentum. We're getting Adobe results later this week, so that could kind of add some complexity to the story.
Okay, as ever, we have to keep an eye on what happens with NVIDIA for that broader look on the AI demand picture. So from chips to chocolate and cocoa. This is a real story. It has implications, of course, for Côte d'Ivoire and other suppliers of cocoa. Prices increasing. There's not enough supply. What's going on here, and what are the impacts potentially across the chocolate industry? Yeah,
so futures contracts hit a record 7,000 intraday, which is, not great for someone like me who could literally boost chocolate demand across the globe single-handedly. But across the globe, this really is kind of a supply issue. And in seriousness, bad weather and sick trees are actually impacting the supply in places like Côte d'Ivoire that you mentioned, in Ghana, and that's actually kind of spilling over into chocolate makers. Companies like Hershey's, they're having to increase prices, shrink packages, which is not what you want ahead of Easter, and also use less cocoa in a lot of their products.
Wait, does Hershey's actually use any cocoa in their products?
Those are tough words. They certainly must.
Favorite chocolate bar? I'm going for Tony. Tony's, big fan of Tony's. The Dutch can make chocolate. Who knew?
Yeah, that's exactly right. I love it when you throw in a little bit of peanut butter. So any product that's got chocolate peanut butter. This is a Reese's Pieces.
This is a Reese's Pieces favourite coming from Charlie Wells. Charlie, thank you very much for walking us through some of the key corporate stories of the day and then landing on chocolate. We appreciate it. Charlie Wells, as ever, thank you. Let's take a closer look at some of the other stories on the terminal right now. Bloomberg learning that UBS has started cutting jobs at its Asia private banking division this week as a slump in profits weighs on the region's largest wealth manager. The firm is said to be cutting about 70 people, including relationship managers, mainly in Hong Kong and Singapore, through the end of March. One of the people said, asking not to be identified, discussing a private matter. A spokeswoman for the bank declined to comment. One of the frontrunners to replace Standard Chartered CEO Bill Winters is leaving the bank as part of a broader management reshuffle. Simon Cooper has led the lender's corporate, commercial and institutional banking division for 8 years. According to a statement, Cooper is exiting to pursue other interests. Checking on your markets right now. European stocks currently up just a little over 0.1%, of course, busting through record highs yesterday. Wall Street also in similar state yesterday. Fresh records on the S&P, currently a little bit flat when it comes to US futures. The pound in focus for us today on the back of the economic data that came in slightly stronger, 0.2% growth in January. The pound at 127. Brent getting a pop as well. Oil prices higher at 1% higher on Brent, and Bitcoin continues to grind higher, 73,000 on that major cryptocurrency. Surveillance is ahead. This is Bloomberg.